Welcome to the Allan Small Financial Show. As always, I want to thank everyone for taking their time out of your busy day to share with us. We have a jam-packed information show today. A lot of information to talk about, parse through. I want to answer as many questions as I can at the end of the show. And of course, we have a great guest. Dan Kelly from CFIB, Canadian Federation of Independent Business, will be with us today talking about small business. What's going on with small businesses. And as I said, well, as always, we'll move on to our usual topics. And here they are already for us. Again, as I said, small business update, an interview with Dan Kelly. We have our this week's segment where we talk about what I believe is important for individual investors to consider before you make your investment decisions. Update on the market turnaround. As some of you may know, I've been calling for the markets in general in North America, to have a bit of a turnaround month of October. We tend to see that. I think the market turnaround is well underway. We'll talk a bit about that. Sectors that have worked for individual investors so far this year. Well, I guess we could sum up that segment in one word: technology. We know tech has been the driver of markets really since the beginning of the year and hasn't really stopped. Technology has taken some breaks here and there, but for the most part, tech stocks and technology, artificial intelligence has really been the driver for all the gains, or at least much of the gains that we've seen this year. Consumers worried about retirement planning. There's been some surveys that came out that have said that more than half of Americans are worried about their retirement planning, worried about their retirement. I know Canadians' survey came out saying the same thing. They're just not sure. People are just not sure what they need to retire on. What amount they need to retire on. And so we'll talk about that. And last but definitely not least, the Israeli-Hamas situation. Obviously, I don't think anybody could be living in this city or anywhere in the world right now and not see some of the horrific, stories that have come out of Israel. It's just a total tragedy. And now we're seeing, obviously, the conflict rage forward. The hope, obviously, is that this will be over sooner rather than later with the least amount of casualties as possible. So we'll touch on the Israeli-Hamas conflict and how that affects or potentially could affect your money and the markets. And lastly, hopefully we'll take a few questions from all of you. Some of the questions we've received during the show, some questions I've received throughout the course of the last 2 weeks. So if any of you have a question regarding any of the material we're talking about today, or a question on anything, your portfolio, the markets in general, please put it in the comment box. And I have my people looking at those boxes throughout the show, and they'll pull those questions in, and hopefully I can get to some of those questions before the end of the show. So without further ado, let's get on to our first segment, which is a great interview that I had with Dan Kelly. I had the pleasure of catching up with Dan yesterday, and let's hear what he had to say. I'd like to welcome Dan Kelly, President, CEO, and Chair of the Canadian Federation of Independent Business, to our show. Dan has been on our show a few times, so thank you, Dan, for coming on with us and letting us know how small businesses are faring. The CFIB is the largest small business association in Canada with more than 95,000 members, advocating for small business with all levels of government, as well as providing advice, tools, and savings for its members. Dan has been with CFIB since 1994 and became president in 2012. In 2015, Power and Influence magazine named him one of the top 100 most powerful and influential people in government and politics. I'd like to welcome to the show Dan Kelly. Welcome.
Good to be with you, Allan. Nice to see you.
Nice to see you as well. As always, want to just have a chat, kind of an informal chat, and kind of get the feel for how small businesses are doing. We spoke quite a while ago now, and wondering if things have changed. Also have some questions I want to get to that have been, I've been wondering about with respect to what's going on with a lot of the macro data we've been seeing from the government. So let's get to the first question, which is pretty simply, how are small businesses faring, right? A while back, we heard that they were struggling coming out of COVID, struggling under the weight of higher interest rates, et cetera. Has anything changed? And, I know that they're struggling to increase revenues, increase growth.
Yeah.
If they are still struggling, what would you say is the number one issue for most of these businesses today?
Look, yeah, a really good question. And as we look around, and streets are busier again, and parking is harder to find, people kind of think that everything's back to normal or largely back to normal post-pandemic. But for most small businesses, it is nothing like normal times, and demand still seems to be a big struggle for many small firms. Only half of small businesses across Canada, even now, are reporting that their revenues are back to pre-pandemic levels. Half of them are still below 2019 levels of sales. And even those that have had sales return back to normal, they're dealing with as we all are as Canadians, just with a crushing level of cost increases, making profitability really, really tough for most businesses. So we've got a bunch of things happening. We've got lower demand in many small businesses, in some cases because things have shifted over the course of the pandemic. For example, working from home for many white collar workers has meant that a lot of the small businesses that serve downtown office cores, they're just not seeing demand come back to where it was pre-pandemic. We've also had the shift towards more online retail than before, and that's meant for some retailers that they're not getting the demand in store to the degree that they had. But beyond that, businesses are dealing with all of the cost increases, a gripping shortage of labor, rising interest rates that are super high compared to what we've experienced in previous years. That's putting huge pressure on firms, a lot of debt that is still dragging small businesses under, both personal debt, some of it in government-backed loans. So it is a big storm of issues. Optimism levels are low. Our data is not suggesting that there's going to be a recession, but our data from small business owners is saying that growth is super low, and that they're struggling to the viability of their business is in question.
So I guess getting to the question that I wanted to ask you, that I think about all the time, is that we get obviously a lot of macro data from the government, talking about jobs growth, speaking about retail sales doing well. We get a lot of positive data, a lot of it, or most of it, is positive, and yet that leads the Bank of Canada to wonder if they should keep raising interest rates.
Yeah.
When we speak, we're hearing that a lot of the small businesses are struggling. So I guess the main question I have is, why aren't these struggles playing out in the macro data? Why does the macro data still show strength?
Yeah, look, we've seen some big shifts over the course of the pandemic. So the places that spending was focused on prior to the pandemic isn't necessarily the same spots that it's focused on post-pandemic. Especially with inflationary pressures that average Canadians are facing, some of the spend with higher prices attached to it is going to more necessary goods, and so service related businesses, and other small firms that are specialty retailers, for example, are seeing drops in aggregate demand in their types of firms as well. So yeah, the macro data can certainly hide a lot of the story. And that's why we put out, CFIB has a business barometer, monthly business barometer. Your listeners can subscribe to it to get a sense of what's happening in what I call the non-stock market economy. These players are really, really struggling still. And a lot of that, I think, is just a bunch of untold pressures that are coming home. We were told, of course, during the pandemic that there would be these boom times post-pandemic where we'd all be spending our brains out with all the savings that we had accumulated over the course of the pandemic. And while that may have been true for some, there certainly weren't very many beneficiaries in the small, medium-sized business world that feel like that has actually happened. Demand is a problem in most small businesses, so our data tells us.
Yeah, and I think you make up a good point. There's definitely a difference between the stock market business or market and the small business. Obviously, a lot of the small businesses, or most, aren't trading on the New York or Toronto Stock Exchange or New York Stock Exchange. And so that business is totally different than what we see in the stock market, which, depending on which sector you're looking at, perhaps has had an okay year, especially if you're looking at the tech sector. So a big difference between the big companies and the small companies. And I think, a lot of people are still shopping at Amazon, so their earnings are still doing well. Meanwhile, the small little retailer, in middle of Toronto, for example, is struggling under the weight of, like you said, higher costs. Kind of shifting gears a little bit here. What is happening with the CBA loan repayment? I wanted to ask you about that because
Sure.
I actually had a meeting with a client of mine, and he was trying to figure out whether he should pay back the loan or
Yeah.
not, whether he should just take the hit of I think it was, I forget what the percentage was of a
Yeah.
penalty for not paying it, or he should, I guess, go into his savings, his investment accounts, which I manage for him, to pull out that money to pay back the loan. And so obviously, businesses are struggling enough that they're finding it hard to pay it back. So what's going on with the CBA loan repayment?
Yeah, look, when the CBA was first issued, the Canada Emergency Business Account, it was a $40,000 loan. And if you took out that loan from government to help you get through the pandemic, you got to keep $10,000 of that loan. There was a forgivable chunk. You had to pay it back by the end of 2022. The government then added another 20 grand to the loan when the pandemic dragged on longer than anyone expected. So it became a maximum $60,000 loan, and up to 20,000 of that, a full third, is forgivable if you repay the balance. That deadline to repay the balance was extended a couple of years ago to the end of 2023, so just a few weeks from now. Small businesses have said, look, the pandemic lasted way longer than anyone anticipated. 2 weeks or 2 months to flatten the curve became 2 years of restrictions on and off. And so many businesses just don't have the money to repay the 40 grand in order to keep that $20,000 forgivable chunk. With the deadline coming towards the end of the year, we've put huge pressure on the federal government to give us another extension to give businesses more time to repay the loan. So the federal government just a few weeks ago announced, with big celebrations, the Prime Minister himself announced that there would be a 1-year extension to CBA loan repayment rules, and businesses started to celebrate. Business owners were so relieved that they'd have some extra time. Of course, we read the fine print pretty fast of that agreement, and it wasn't a 1-year. There is technically a 1-year extension to the ultimate deadline to repay the full loan. But for that forgivable chunk, if you want to keep the $20,000 forgivable portion, the government's extension was 18 days. Wow. So now business owners have until January 18th, 2024, about basically 100 days from now, to find the money to repay the $40,000 and then clear off their debt. They would then be forgiven $20,000 on the loan itself. 18 days expansion is not what we were looking for. It's deeply, it's created great amounts of anger on the part of business owners for the kind of the bait and switch that the feds used. But we have our data shows that we have about a third of our members that have the money or can easily get the money to repay their CBA loan. They'll be okay. We have about a third of small businesses in Canada right now who said, I can't afford to take on another $20,000 in debt. So I need to borrow the money or find the money to repay my CBA loan. In some cases, it's with really tough decisions that they have to make about foregoing perhaps an expansion or laying off a person in order to repay that. And then there's a full other third of small businesses that are saying there's no way, no how they're going to be able to repay their CBA loan by January 18th. They're going to miss out on the forgivable chunk. Their loan balance, if you don't repay it by the end of January 2018, by January 18th, 2024, you now have a $60,000 loan. You lose the forgivable chunk, but you do have an extra year to repay. You have 3 years now for 2024, 5, and 6 to repay the full $60,000. So like your client, business owners are doing the math right now. Am I better off to beg, borrow, or steal hopefully not steal the 40 grand in order to clear off this debt and keep the 20,000? Or am I better off to just suck it up, make my loan go up by 50% to a $60,000 loan, but I will have 3 years at a 5% arranged interest to pay it off? We've got some advice for small business owners on the CFIB's website, cfib.ca. I wrote a letter to members. In some cases, they will be better off with either approach. But that for you to pay it off means you have to have the available credit to be able to borrow the money if you don't have it to clear this debt.
Amazing. Most of these small businesses, obviously, they took this loan because of that forgivable portion,
Right.
or else probably most of them or many of them may not have even entered into this agreement to start with. So interesting that the government says, yeah, we'll push it off, but then we're not going to forgive a portion of that loan that we originally sold the idea on.
Yep.
So it's a tough one. I guess final question, more general question about small business. So there was a BDO Canada executive recently suggested that aging population and higher wage demands were, I guess, causing small business owners to sell their businesses.
Right.
Obviously, we know about the higher costs, whether it's higher interest, inflation, higher cost of materials, and combining that with wages, and then combining the idea that a lot of these businesses are owned by older folks. Do you agree with this survey? Are you seeing that these are two of the main causes of small businesses, I guess, being sold or no longer in existence?
Oh, look, there's absolutely no question. Our data at CFIB strongly parallels that. In fact, we see that 70% of small business owners expect to leave the running of their business in the next 10 years. 70%. Wow. It is a huge number of small business owners that for demographic or financial realities need to find an exit ramp from their firm. Just on the demographic side alone, though, business owners generally work much longer than government workers who retire younger than anybody, but even younger than most private sector workers in paid employment. Business owners stick around much longer. My favorite story is one of our farm members, a small business owner in the ag sector, said, finally, Dad showed me, because he's preparing for succession, he finally showed me the books of the business. I'm so excited to take the reins here. That guy that said that was 65, and his dad was in his 80s, showing him the books for the very first time. So small business owners often talk about succession and then don't do it because they love it or they need to do it to pay their bills. And so they drag this out, but the clock doesn't last forever, right? So we're at the point now where business owners are going to be turning over just because the clock is ticking. Financially, though, you're quite right. There have been a lot of business owners motivated by the fact that their costs are rising, income is not, and so they are motivated to sell because they're just not. Getting a profit out of your business right now is super tough, and so many businesses are saying, I got to hang up the keys here, and winding down my business or perhaps selling my business may be my best outcome.
Yeah, it's a scary number, 70%. Wow, you wonder what real estate's going to do at that time if a lot of businesses go vacant, a lot of offices go vacant, a lot of spots in the city of Toronto or wherever else go vacant. That's a scary thought. Dan Kelly, President, CEO, Chair of the Canadian Federation of Independent Business. Thank you so much for being with us this afternoon. Always a pleasure speaking to you and giving us some insights into how things are faring with the average small business out there.
Good to be with you anytime at all.
All right. Thank you so much. That was a great, informative interview with Dan Kelly. So much appreciated. And thank you, Dan, once again. Now we come to the part of the show where I talk about what I believe is important for individual investors to consider before they make their investment decisions. And as always, we have three topics or three ideas to focus on. The first one, third quarter earnings. We just started the third quarter earnings season, and pretty much U.S. banks have been the main focus so far. Today, we will get earnings from, I believe, Netflix, Tesla after the bell, but so far, the big banks and even some of the big regional banks have reported. So that's something to focus on. We'll touch on that a little bit. U.S. government bond yields, one of the mainstays of this segment of our show. Bond yields are definitely going higher regularly, and we're starting to see the 10-year in the US approach 5%. And the third topic or idea to consider, dividend stocks. How to choose dividend stocks. We all know dividend stocks are a fantastic idea. You get paid a good dividend while you wait, but is it just enough to buy stocks that are paying good dividends? Or should you consider something else as well? So let's go to the first idea, which is third quarter earnings. And as I mentioned, we've heard from the big banks, whether it was the biggest banks, JP Morgan, second largest Bank of America, Citibank, Wells Fargo, etc., some of the big regionals. I think the main message is that these banks are telling us they're doing fine. A lot of these banks, with the exception of some of the reports we got, I believe yesterday, and I think today, Morgan Stanley as well, they were a little disappointing, along with Goldman Sachs yesterday. But the other big money center banks, Cities and the Bank of America, they're doing quite fine. And in fact, in some cases, the money they're making, the net interest margin, which we've talked about in previous shows, so that's the spread between what they're charging for loans and what they're paying out to investors, is actually growing a little bit. So that's a positive thing. So let's take a look at a chart, and I think the first chart we have is one of Bank of America. And keep in mind, as I said, Bank of America reported really good earnings, but I think from some of these banks, the CEOs, the stories they're telling, the information they're giving us is probably more important than this chart itself. And if you look at the chart, you'll see Bank of America trading at a low point. Its yields are getting in that 3 to 4% range. Stock is trading down at $27, $27.50, down from back when it was trading in that $40 to $45 range. So quite a bit off. But more importantly than the chart, CEO of Bank of America, along with the CEOs of JP Morgan and Citibank, they're starting to tell us that all the savings that individuals had, I guess, built up from the pandemic times, the COVID times, and some of the government subsidies or programs, they didn't travel as much. So they had a lot of savings built up and were sitting there. A lot of those savings are now being spent, and we're seeing them dwindle away. And so savings accounts aren't as large. There's not as much money in them as there once was. So that, to me, has been the main message that I'm hearing from these banks, that savings accounts are starting to fall, the values are starting to fall, which means, according to these CEOs of these big banks, that they foresee a time when spending will significantly slow down. We haven't seen it as yet. We continue to see retail sales numbers in the US especially doing extremely well. People are still spending, whether they're using cash or credit. We're seeing plastic being used a lot more these days. Whatever it is, it will start to slow down. Another chart we have here, Bank of America, one on PNC Financial, the largest regional bank in the United States. Again, this bank pays over a 5% dividend yield, so you get paid a nice dividend while you wait. And another name that I think reported pretty good earnings. Stock jumped initially into the low 120s, but has pulled back since. Another bank in the US, one that we all love and talk about frequently, is Citibank. Citibank, big money center bank, Citigroup, pays over a 5% dividend. Now, that's not something you see often. It's been in around 5% now for a little while, but prior to recently, the recent downturn in the stock into the low 40s, we really didn't see Citibank trade this low with such a high yield. So overall, corporate earnings season, in my opinion, has started on a good note. I heard a stat just the other day saying, even though we were still early in the early days of corporate earnings season, 92% of the companies that reported, and obviously mostly were banks, beat or exceeded expectations. So that is a good start, and hopefully the other sectors can pick up from there. The second idea that I want individual investors to consider before you make your investment decisions is this whole idea of US government bond yields. And we're watching these yields very closely because, as we know, as yields rise or interest rates rise, stock market tends to fall. Interest rate sensitive parts of the market, like technology, which make up, especially in the US, a large amount of the index, 30–40% of it, of the S&P 500, is tech. If interest rates continue to rise, tech will probably have a tough time and struggle. other areas, such as real estate, as we know, will continue to struggle, and some other interest rate sensitive areas like utilities and other sectors. So very important to keep an eye on interest rates. And first chart we have here, the US 2-year Treasury rate. You can see it now well over 5%. I think last show it was just under 5%. And today, well over 5%. And the 10-year we have right after that, approaching 5%, 4.87. These are yields, again, US Treasury yields. These are yields we have not seen really going back all the way to 2006. Now, a couple of things to understand. Back in 2006, interest rates were at these levels, of course, but the stock market was actually doing okay, and it did all right until we got into the financial crisis in the end of 07 and into 08. But interest rates can be this high, and the stock market continued to go higher as well. I think the issue is more of the speed of these interest rates rising and the unknown. How much more will they rise? And as I've said on TV, radio, and on our show here, if we can get some certainty with regards to interest rates, I think that will be something that can give a boost to the markets. But one of the things I wanted to mention, and a question everybody's been asking, is why are interest rates so high? Why are they continuing to move higher? Some people will say it's the Fed. You know, they're raising rates has caused the short-term bonds to move higher. Some people will say it's actually the strength of the U.S. economy that has caused interest rates to move higher, as well as the U.S. dollar. But an interesting thing came up just last week. Last week, the U.S. had a Treasury bond auction, and they auctioned off 30-year bonds. Now, why do they auction off bonds? Well, we have a chart to show you why they offer, or they have auctions for bonds and try to sell bonds, and it's to cover their debt, right? The U.S. needs to cover its debt. This is an unbelievable graph, and if it's one graph that stood out to me for this show, it's this one. U.S. federal debt has now surpassed 32 trillion. Yes, trillion with a T. When you look back at where that debt level was, 15 years ago, much lower. You were looking at debt levels under 12 trillion. And here we are almost tripling of that just in the last 10, 15 years. No wonder why a lot of, government officials, senators in the U.S., a lot of Republicans, even Democrats in the U.S. continue to focus on this and complain about these high levels. So what happens is U.S. has to sell a lot of bonds to cover a lot of debt. And of course, if the demand does not meet the supply of these bonds being sold, we see bond prices fall, right? Supply increase over demand, prices will fall, yields will rise, and that's what we've seen. So last week, I believe Thursday, they auctioned off 30-year Treasury bonds in the U.S. The demand was not there for those 30-year Treasuries. Who wants a 30-year government bond when you could buy a 2-year bond, which is yielding higher than the 30-year? So the demand was not there. Bond prices fell so they could actually sell these bonds. Yields had to go higher. And again, another reason for bond yields rising, and therefore stock market fell that day. So we want to keep an eye on U.S. Treasuries, even more so than Canadian bonds. The last topic I wanted to get into, which are your dividend stocks. And everybody wants to own dividend stocks. We talk about it all the time. But do we just want to own specific dividend stocks that really don't show much growth and just pay a decent dividend? Well, the quick answer to that question is no. Those dividend stocks, I should say, are the ones that are getting hit the hardest as interest rates rise. They tend to be more interest rate sensitive when there's not much growth there than other dividend stocks that actually have a growth component to them. So let's take a quick look at a few charts here. First one is PepsiCo. Pepsi, they reported fantastic earnings recently, taking up expectations for the full year. But as you can see here, their stock has fallen. One of the reasons, it pays only a 3% dividend. You could get a higher rate of return without any risk owning a 2-year Treasury, as we just showed you, over 5%. So who would want to own PepsiCo if it's not showing much growth and you could get a better yield on your money in something that is basically with little or no risk? So a lot of people have sold PepsiCo to move their money into a Treasury bond, maybe even a 2-year Treasury. Next graph we have here, a chart, Fortis. a Canadian utility company, paying a little bit higher in that 4% range. But once again, who's going to want to own Fortis for the income they provide when you can own a short-term government bond that is paying higher? Looking at another name here, Rogers Communication. Again, 3.5% dividend. Rogers not showing a lot of growth, like many of the telecom stocks like BCE and TELUS. People are selling their telcos and buying short-term treasuries. The next chart I want to show you is kind of opposite of the first three charts I just showed you, and that's of Broadcom. Now, Broadcom had, for a while there, over a 3% dividend yield. The stock, as you can see, has run up tremendously. So now that dividend yield's about 2.25. But even though you're getting a smaller dividend, you're getting the potential for a lot more growth. And so what has happened is investors will say, you know what? I'll go into Broadcom. I'll make a couple of percent just for owning the stock, but also reap the rewards that Broadcom offers us, which is share appreciation. And we've seen a lot of that share appreciation in the last few years. And the last chart I have, part of this segment, is a chart of Bank of Nova Scotia. I just talked to an investor this morning, and we spoke about Bank of Nova Scotia yielding as high as 7% today. Just for owning the stock, you're going to make 7% return. But I also believe you will get capital appreciation or growth out of this name as well. And that is a name I think people can own, of course, if you can handle the volatility that a name like Scotiabank brings. So owning dividend stocks just for the dividend and very little growth is just not worth it anymore. You want to own names that can pay a dividend, but it can also grow. And I think in this higher for longer interest rate environment, those are the names that are going to win over the long term. So I've spoken many times about the market turnaround month of October, and we've seen it time and time again. Probably the best example was just last year. We came into October at a low point. Everybody was sort of down and out. Investors were pretty negative, and little did we know, October was the low point. And from there, we saw the markets really take off and really didn't start to fall back until August of this year. And here we go again, seasonal activity, September being a very poor month, which we just went through. And here we are into October again and waiting for another turnaround. We have a chart here, a 1-month chart of the S&P 500, and it's going to show you that the turnaround is actually happening. So for all of you investors out there that have been negative on the markets, this is showing you that maybe you shouldn't be as negative. I believe the fourth quarter, like many fourth quarters in history, will be a positive one and will end the year higher than the number or at the level that we came into the fourth quarter at. And October, as I've said many times, you come into Canadian Thanksgiving, you coming in on a low, at a low point, things turn around in and around the first maybe 10 days of October, which coincides with Canadian Thanksgiving. And then we end the month on a high note, and November tends to be one of the best months of the year for investing. And so to me, what is the catalyst that's going to get the fourth quarter to be a positive one? I think it's interest rates. I think we're going to stop seeing the rise of interest rates. We're already hearing from Fed governors that, talking a little more dovish, as we say, basically saying, well, maybe we can wait a little bit to see how things go because inflation is not really moving up much. In fact, inflation in the U.S., core inflation, has come down into the low 3% level. So overall, we're still seeing the U.S. economy grow. We're seeing the Canadian economy grow, albeit at a very slow rate, a lot slower than the U.S. But we're seeing inflation fall. So I think central banks will communicate to us over the next couple of months that they're not so quick to continue to raise rates. And that, in my opinion, will be the catalyst to take this market to the next level. And as predicted, we'll see the turnaround in October, and we'll see the follow through for the rest of the quarter. Sectors of the market. You know, we've talked about all year how really one sector has driven the bus, has basically made the difference. And that's the tech sector, right? We've spoken about it. And obviously, tech sector is quite large, as I mentioned, big chunk of the S&P 500. But there are different tech stocks, different technology companies that make up different parts of the market. And so to say, well, tech is running the show, I say it is correct, but you have to delve into it a little bit more. There are certain parts of tech that are doing better than others. And we've talked about artificial intelligence, companies involved in AI, companies involved in software, hardware, the cloud, infrastructure. So there are a lot of parts to tech, but overall, yes, technology has been one of the biggest winners, if not the biggest winner. So we have a chart here, I think, that really breaks down the S&P sector performance. And you'll see here the S&P 500, kind of middle of the road there. It's about 10, 12% higher on the year as compared to the TSX and the Dow, which are pretty flat for the year. The NASDAQ up quite a bit, again, led by technology. So you can see here some of the sectors, communication services, again, you might call it technology, but we break it down and call it communication services. We've also seen information tech, infotech as being a big gainer, consumer discretionary. We have another chart here that goes into, again, even more statistics for us, which is the chart which shows, and I point you to the second column, because that's what someone like me would look at, especially someone who's managing money for individuals, the PEs of these sectors. And you could see communication services doing very well this year, trading at a 40.7 PE. Compare that to where energy is, 9.5, and you can see which sector is a lot cheaper than the other. So I've talked about this before, paying a premium for growth. Well, you're going to pay a premium for communication service companies. You're going to pay a premium for consumer discretionary, technology. These are areas where if they're showing growth, you're going to have to pay a premium for. And what I don't want to do is pay a premium for consumer staples, which aren't doing as well. And you can see here, the PE on a consumer staples, the sector in general, is very high. And so putting a little more context into these sectors, and I wanted to show some different stocks that are trading in these individual sectors. So we have a chart, S&P 500 sector chart, and it shows you some of the stocks that are in those areas. So communication services, what are some examples? Meta, Netflix, Walt Disney, consumer discretionary, doing very well. Amazon, Starbucks, staples, down for the year. Coca-Cola, Pepsi, Philip Morris. So you can see those stocks, if you're a fan of the market and been watching the market, you know those stocks haven't been doing too well. Financials, we went through a few of them, Bank of America, JP Morgan. Obviously, this is a US chart. Technology, down at towards the bottom, second best performer. What do we call technology according to this chart? Alphabet, which is your Google, Apple, Microsoft, NVIDIA, Tesla. So putting into some context, some of those sectors, but you can clearly see that tech-related, anything to do with tech, whether it's you want to call Amazon a technology stock, Tesla a technology stock, or whether you want to call Google a technology stock, anything to do with technology has definitely shown to be driving the bus for this year. And I believe it will continue to do so heading as we finish the year and into 2024. A recent survey that I saw showed that over 50% of Americans were struggling with retirement planning, retirement savings. And I saw another survey from Canadians as well, feeling the same thing, that they're worried that they just don't have enough to retire on. And in fact, for many, they don't know how much they need to retire on. And an interesting chart we can pull it up now as well, that shows how much the discrepancy between what people think they need, the amount they need to retire on. You can see it's pretty widespread from under 150,000, 10% of people think that's good enough, to 1 to 2 million, 13% people think that's enough, 2 to 3 million, 7%. And then the biggest number, which is right at the bottom of the chart, 25% of people just don't know. And I think that's where the help of an investment advisor can come into play. What I do with my investors, my clients, people that I talk to, I start off by saying, what are you earning today? How much are you taking home on a monthly basis? So you look at that number, and that's a good starting point. Now, you may need less than that when you decide to retire. You may need more than that. And I must say that for the most part, most people don't really need more. So sometimes they need less once the kids, I guess, leave the house and move off and are self-sufficient, can do it on their own. It also is going to come down to how much you spend. Do you want to lead a life in retirement where you're traveling 2-3 times a year? Become a member of a golf and country club? How much do you foresee spending? Some of us, as we know, unfortunately, will have more medical bills as we get older. So the cost will start to rise as we get into our late 70s, early 80s, and beyond. So figuring out how much you need really is something that will change over time. It's a roadmap. And as we all know with roadmaps, you plan the best way to get to where you want to get to. But if there's construction, traffic, what do? Well, most people today have Waze or Google Maps, and they figure out another route. And that's what retirement planning is all about. Coming up with a number that you think makes sense, but then it's going to change probably multiple times, just like your route on the way to your destination. If you're going downtown Toronto or wherever you're going to a friend's house and there's traffic, you're going to deviate from your original plan. And I think a retirement portfolio will do the same. You're going to deviate from your original plan probably multiple times, but as long as you're doing the numbers, crunching the numbers on a regular basis, maybe every few years, you'll know if the path you're taking is the right one. And I think you will feel more confident as to the number that you're working towards for your retirement. I couldn't help but to put this segment into our show. It is a very sad one for many people, for myself, for I guess everyone that has seen some of the pictures out of Israel, have heard the stories out of Israel over the last weekend, the attacks by Hamas on civilians. But obviously, this is a business show, so we want to keep it to business. And I want to say that the markets have been quite resilient, actually. They've taken in what's going on. And I guess the number one worry for most people was that because Hamas, Hezbollah in the north and Lebanon and some of the other terrorist organizations are funded by Iran. We know Iran is a very large producer of energy or oil. And the Middle East in general, obviously, Saudi Arabia, big producer of oil. The fear was that we would wake up Monday morning, even though it was Thanksgiving here in Canada, US markets were open. The fear I had was that the markets would open up significantly down, led by a spike in oil prices and the idea that there's a new war raging in the Middle East and a new war for us to consider around the world. We know that the Russia-Ukraine situation has not fixed itself, or there's been no stopping of the violence and the war there. And now we have a new war to contend with, something that many are focused on over the last 10 days. However, as we'll show our chart here, we'll actually show the one-year oil chart first. You can see that the price of oil has spiked significantly over the last year, starting in July. I think that has come about from this idea that the markets are doing better. China is back into the mix, coming out of their COVID lockdowns, even though their economy is struggling to get back to its former strength. We're seeing oil prices go higher based on restrictions on Russia. We just heard some more sanctions by the US on Russia, which has caused price of oil to rise again. But if you look at, I guess, the 1 month chart of oil, which we also have, the terrorists went into Israel on October the 7th. And as you look here, you see an immediate spike in oil just after that. And then you see oil prices fall. And since then, they've gone up once again. And as I do the show, oil prices are even higher today, approaching $90 a barrel again. And so there's this push and pull between what's going on in the Middle East right now and this whole idea of slowing growth, which is no good for the price of oil. A strong dollar is also a negative for the price of oil, WTI, which is what we watch. So what we're seeing is the fears that we had regarding the stock market haven't really played out in the oil markets and haven't really played out in this with the stock market either. We've seen the stock market quite resilient and actually go even higher, as I mentioned to you earlier, on a turnaround October. And right now, at least so far, we haven't seen things get worse with respect to more countries getting involved in this war. So hopefully we will see an end to this war sooner rather than later. Hopefully we will see the terrorists, I guess, be infiltrated and hopefully taken care of. I know there's a lot of talk that this is about to happen. We haven't seen it yet. Hopefully other countries do not get involved in this war. And hopefully we can see an end to it as soon as possible with the least amount of casualties. And from a business perspective, with the least amount of damage to the markets and the least amount of damage to oil and the production of oil. Now we come to the part of the show that I always say that I love the most, which is true. It's taking your questions. And, I never leave myself enough time to take a lot of questions. But as you all know, I try to get to questions either during the week, answer them personally to people, give them a call or send them a message, or answer them on the next show. So we have here a question. Is now a good time to invest in bonds? How do they differ from stocks? Well, as we know, bonds are a lot different than stocks. Buying a bond is actually buying debt or lending money to a corporation, a government, and in return, they give you back that money after a certain period of time, and they pay you interest for borrowing that money. A stock is actually ownership in that publicly traded company. So if you own a few shares of TD Bank, well, in essence, you are an owner of the bank, albeit a very, very small owner, but an owner nonetheless. So is it a good time to invest in bonds? Well, bond yields are now in and around 5% on short-term bonds. So much higher than the 1-2% that it was a couple of years ago. But again, as I've said many times, I think you have to look at your investment objectives. You have to try and figure out, is it growth I'm looking for, or is it just capital preservation I'm looking for? Because if you're looking for growth, even bonds at 5% with a 3-4% inflation rate, subtract taxes if it's owned in a portfolio that's outside of an RSP, you're still not making a lot. And so is that growth? No. To grow a portfolio, I believe you still need to be invested in some capacity in the stock market through individual stocks, ETFs, mutual funds. That is the only way that you're going to get growth. Take one more question here. With interest rates rising, is it a better time to invest in banks as they will be making more money? As I mentioned earlier in the show, yes, banks make more money if they can charge more for the loans they provide. What we all are watching is how much interest do they have to pay people to keep that money at the bank. If a savings account is paying 1-2% and you could buy a government bond at 5%, who's going to give money to the bank? Nobody. So banks have had to increase what they're paying out on their high interest savings accounts. As well, banks themselves own a lot of long-term bonds. As I mentioned, long-term bonds, pricing of those have come down. So banks that own those bonds actually have these bonds on their books at a loss. Not good for banks. And lastly, banks aren't lending as much. Capital requirements are moving higher. Government wants banks to have more money on the sidelines. So banks aren't lending as much. So they're not making as much. So there are a lot of unfortunate negative things going on at the banks right now. I still believe banks are a good opportunity. They're low right now. They've never cut their dividend in history. Those are Canadian banks, that is. And I think a good opportunity, as I said earlier in the show, to own a good quality bank for growth and income. With that, I want to say thank you for being with us today and taking the time out of your busy day. Please catch our next episode, which will be on Wednesday, November the 1st, 12 noon. As always, we're going to have Maureen Harkwell on of OMVIC. And she's going to talk to us about the consumer in the automotive industry. A fascinating interview. And I hope you all can come back and watch it in a couple of weeks. So until then, I want to wish everybody happy investing.